Ever find yourself just staring at a stock chart, maybe, the Nifty 50, and it just feels stuck, like it's hitting the same high, bouncing off the same low, going nowhere
Oh,
fast?
yeah. Sideways City, right. Stuck in a range.
Exactly. So today we're doing a deep dive into something that might signal the end of that sideways grind. It's called a horizontal breakout, specifically when it breaks to the upside.
Precisely. We're going to unpack how you might spot these and potentially, act when the price really punches through one of these horizontal trading zones. We'll use the Nifty 50 as our main example today.
And look, this isn't just dry theory, right? Understanding this pattern can actually give you a clearer strategy, maybe help you figure out when to enter what could be a strong upward move, cut through some of that day-to-day noise.
That's the idea. We want you to feel a bit more clued in, maybe less overwhelmed when you see these sideways patterns forming on the charts.
Okay. And we're basing this on some expert analysis, yeah.
Yep.
A kind of step-by-step approach.
Yep. It looks at trading these horizontal breakouts,
Yeah.
but it's more than just price crossing a line. It folds in things like the bigger market picture, trading volume, how much is actually being traded, and the specific price action. All things that help build conviction.
Got it. So, first things first, identifying that consolidation range. What exactly are we looking for on the chart?
Okay, so you're trying to spot a period where the Nifty, in this case, has been sort of bouncing between a clear high point and a clear low point, like a channel, but flat.
A horizontal channel.
Exactly.
Right.
And ideally, you want to see the price having touched both the bottom, the support, and the top, the resistance, multiple times. Think maybe 3, 4 touches on each side. That shows the level is respected.
And why is that back and forth important? Why multiple touches?
Well, it shows this period of balance. Buyers and sellers are kind of evenly matched for a while within that range. The longer that goes on, the more energy potentially builds up.
Like coiling a spring.
Kinda, yeah. So when one side, hopefully the buyers in our case, finally wins out and breaks through that resistance ceiling, the move can be pretty strong. It's releasing that built-up energy.
Okay, makes sense. So, we've spotted the sideways channel, multiple touches. What's next on the checklist?
Context. You got to look at the bigger picture. Is the overall market trend like neutral or maybe already heading upwards? An upward breakout has a much better chance of succeeding if it's going with the general flow.
Right. Don't fight the tape, as they say.
Pretty
Don't do it.
much. And also, are there any, fundamental reasons supporting a move higher? Good economic news, maybe strong earnings, policy changes, that sort of thing.
So context is key. Just seeing the price sort of nudge above that resistance line isn't quite enough then.
Definitely not on its own. You need to see some force behind it. Conviction.
And how do we see that?
Two main things: volume and the price candle itself. So as the price is getting near that resistance level, you ideally want to see trading volume start to pick up.
More people getting interested.
More participation, yeah. Suggests buyers are stepping in more aggressively. Then, when the actual breakout happens, look at the price bar or candle for that day. You want it to look strong, bullish,
Meaning?
meaning it closes near its high point for the day.
Yeah.
Shows buyers were in control right to the end, not a candle with a long shadow sticking out the top, which might show sellers push back.
Okay, so range identified, market context checked, volume picking up, strong breakout candle. Now we jump in.
Hold on just a sec. It's usually smarter to wait for a little confirmation, just to try and avoid those nasty false breakouts.
Oh, the head fakes where it pops up and then dives right back down.
Exactly those. So confirmation could be, say, the price closing above that resistance level for a full trading day. Or sometimes it breaks out, pulls back to touch that old resistance line from above.
Which should now act as support.
Right. And then bounces off it and heads higher again. That retest and bounce is a classic confirmation signal.
Patience pays off then. Avoids getting whipsawed.
It certainly can. Oh, and speaking of breakouts, there's a particularly interesting type, the blue sky breakout.
Blue sky, what's that?
That's when the price breaks above a resistance level. And there's basically no significant price history immediately above it. No nearby overhead resistance levels waiting to stop it.
Ah, clear sailing ahead, potentially.
Kind of, yeah. These can sometimes lead to really strong, fast moves because there's less friction, less historical selling pressure nearby.
Interesting. Okay, so let's say we get that confirmation, maybe the retest and bounce.
Yeah.
Then we think about the trade.
Yes. Then you start planning the actual trade. Where do you enter? Maybe right after confirmation, maybe on that pullback. And crucially, where's your stop loss?
The safety net. Where you cut your losses if it goes wrong.
Absolutely essential. You need to know your exit point if the trade moves against you.
Yeah.
And then you also need a target. Where are you hoping to take profits?
How do you figure out a target? Is it just guesswork?
Not really guess rate, more like educated estimation. A common way is to measure the height of that sideways range it broke out of.
Okay, the distance between the support and resistance.
Yeah, measure that distance, then project that same distance upwards from the breakout point. That gives you a potential target area. Or sometimes people use tools like Fibonacci extensions. The main thing is your potential reward should justify the risk you're taking based on your stop loss.
Right, the risk-reward ratio. Always important. Okay, so let's recap the key steps here. What are the absolute must-dos?
All right, the core things are: 1, find that clear sideways range with multiple touches top and bottom. 2, check the broader market context, ideally neutral or bullish. 3, watch for rising volume and a strong candle on the breakout itself.
Got it.
4, wait for confirmation like a solid close above or that retest and bounce. And 5, have your plan: entry, stop loss, and a profit target.
And you mentioned that blue sky scenario as being particularly potent.
Yeah, it's worth watching, but think about the Nifty maybe consolidating for, say, 6 weeks below 22,500. If it then breaks clearly above that, and there isn't a lot of old price action immediately higher up, well, that could be significant.
Like clearing a major hurdle.
Exactly. And sometimes you see fundamental news providing the catalyst. We saw an instance where, after a similar consolidation, the Nifty broke above 22,500. It was supported by really strong GDP numbers and good foreign investor inflows, and it led to quite a decent rally afterwards.
So understanding these mechanics, it can really give you those aha moments when looking at charts. It offers a more, structured way to think about potential trades rather than just reacting to headlines.
That's definitely the hope. It gives you a framework.
Which actually leads to a final thought for you listening. Now that you've got a handle on horizontal breakouts, what other chart patterns out there might give similar kinds of clues about where the market might be heading next? Maybe think about how combining different techniques could sharpen your market view even more.